Please resume.
Thank you. Principle number one, to repeat, is everything in the universe follows the path of least resistance. Second principle is this path of least resistance is determined by the always underlying and usually unseen structure. Let me give you a couple of examples. Let's say that a river is running down the mountain. The decision that that river makes, whether to be rapids or a calm pond or whatever, is not determined by the river, but it's determined by the riverbed. So if the riverbed is shallow and narrow, it's going to be fast. If the riverbed is wide and broad, it's going to be a pond. Same thing is true in the market. If the underlying structure of the market is shallow and narrow, you're going to have a trend. If the underlying structure of the market is broad and wide, you're going to have a trading range or a bracket. If you were to get up right now, let's say that you had to go to the bathroom, what you would do would be you would squirrel out of wherever you are, and you would go through the door here going that way, then you would turn that way, and then you would go down the hall a little bit, and then you would turn right again, depending on whether you were male or female, and go in one of those doors. Now, the restroom's right over there. Why don't you just go right over there? Because you have learned in your experience that walking into walls does not generate a high level of wellness. So the question that I'm asking you is, as you were going to the bathroom, you would probably be totally unaware that your behavior is being controlled, number one, by the architect who drew the blueprints for this hotel, and by the building contractor who happened to put the doors here and there and go there to go to the bathroom. But your behavior is described by the always underlying and usually unseen structure. Now, principle number three is that underlying unseen structure can be discovered and it can be changed. So if I see a lot of traders, my vision of a lot of traders is that they're in the market and they're trying to change the river, and they're doing it with bucketfuls, trying to get the river. Where if they go up the mountain, and where that's just a small stream, and turn a couple of rocks or so, they might run it down the other side of the mountain and absolutely change the whole behavior of that river. One of the things that the science of chaos absolutely destroys is Newton's three laws of motion, and I'm sure you learned those and memorized those in college and everything else. There is not an equal effect for every cause, and they call this the butterfly effect. And one of the examples that Mandelbrot uses is that there's a little monarch butterfly somewhere in South America, this little bitty tiny thing, and he's flying over here to this sexy flower to get a piece of pollen, and he decides there's a better looking flower over here, so he changes it and flies 3 feet over in this way. Now that sets up a little air current, and that air current sets up another air current that sets up another one that causes an El Nino, that causes a drought in the west, that causes beans in the teens next year. Now, if you could talk to that monarch butterfly, you could retire next fall, couldn't you? If you knew exactly how all of that worked. It isn't that simple. But it is a new way of looking at living things and turbulence. And with these three principles, then we can make a great deal of progress. Now, what we're going to on page, if you turn over to, well, just stay on that page. And let me show you this, which is the same thing, saying it another way. One of the things that we have deduced from the study of chaos, and one of the problems with trading commodities is simply this, that there is no little league. There are no training wheels. If you have $2,500, you can buy a bond. And with that one bond contract, you're in competition with the best, shrewdest, biggest, smartest institutions in the whole world. And it's you against them. You're in the 15-round championship fight. And there's no way to learn to trade. You can go to the Mid-America and trade many contracts, but you're still working against the smartest traders in the world. And since 90% of all traders lose money, there needs to be some way to know how you're trading instead of just collecting a bunch of indicators. And what we do is simply this. We start out at step number one. Now, at step number one, you are, and this corresponds to, this is the same thing that's on your page number 6, just in a slightly different format. At stage number one, you are what we call a novice. Now, a novice trader is simply one who is in the market and not losing money. And let's compare this to Let's compare this, for example, to music. Let's say that you went to a concert and you were just overwhelmed with somebody who was playing the piano, playing Mozart sonatas. And you came home and you said, whatever it takes, I'm going to play the piano. I'm going to learn to play the piano. I may not have any musical talent, but I'm going to play the piano. So you go out, you buy a piano, you buy a book, and you buy an instructor. In a similar way, you were probably attracted to trading by somebody that you knew, or somebody, or the idea of making a lot of money without having to work for it, right? And when we are attracted to something like this, we get what psychologists call germination energy. That means your energy goes way up. You've experienced this in romantic associations. I mean, you have this new love on the field out here, and all of a sudden you can work all day, dance all night, work all day, dance all night, never get tired, everything goes right, because you have what they call germination energy, which is a big spark of energy coming. So you come into trading and you say, man, I'm going to do it. And the worst thing that can possibly happen to you is that you start winning, because then you think you know what you're doing. We had a Hollywood movie producer-director come to one of our tutorials, and he came to one of our tutorials, and I said, why are you here, Joseph? And he says, well, I'm here because I want to learn to trade bonds so I can make enough money to finance movies. What do you think about that? And I said, well, I think you're crazy, first of all, because you're taking one high-risk venture to support another high-risk venture, and the statistics just aren't there. And I delved deeper into it, and his history was that he had this idea on his own. He started trading bonds. And in the first 4 months of bond trading, Joseph made $800,000. He'd never traded before. Now, it took him 9 more months and losing slightly over $3 million before he decided he really didn't know everything about bond trading. And then he said, well, you know, maybe I should do something else. So the novice level, the purpose of the novice level is to not lose money while gaining experience. And the tools of that level are the bar, the open, high, low, close, the volume, the Profitability Market Facilitation Index, the Profitability Windows, and the airbag. And let's talk about, just for a moment, the volume and the Market Facilitation Index. The last thing that ever changes in the market is the price. What changes before price is momentum. What changes before momentum is volume. What changes before volume is thousands and millions of traders just like you and I who are making these fractal decisions in our brain. So, one of the comments that you hear today oftentimes is that a lot of individual traders are bemoaning the fact that there's so many large institutions. Do you know that we're approaching 3 times as many mutual funds now as they are stocks on the New York Stock Exchange? And there's an average of 6 new mutual funds every day being put into effect. So we have all of these big institutions. Well, I love that. I mean, I think that's going to be great, because there's a whale of a lot of difference between trading, say, $10 million and $1 million. If you're trading $10 million, you are a dinosaur. I mean, you cannot get in and out. And with all these dinosaurs around, what I want to be is a little cockroach, because I can get in and out, and I'll survive evolution. These dinosaurs may go, but I have a chance of surviving it if I'm a little cockroach running around. So that's not a fear. Now, what will happen, and what that has done, which is very different from back in the 70s. In the 70s, it was a very different market. We not only had inflation, constant inflation, but we also had trends. And back in, especially in the late 60s and the early 70s, if you were trading in soybeans and you could take a nickel hit, you could go on a 2-week vacation and not worry too much and leave it open, because it wasn't going to change. The other day, the soybeans changed 17 cents in 34 minutes. That just didn't happen back in those days, and it was longer-term trading. Now you've got to be much more of a cockroach. And what happens is, if this is the volume that you see at the bottom of the chart, if this period it has more volume than the last period does, then the only thing that can account for this increased volume is what? Is outside paper, right? Because the locals there's no future. If you and I are local in the pit, there's no future with us trading with each other. We want those guys out there who've got the money, the guys who are phoning the brokers and saying, put me in 1 contract or 10 contracts or 100. If there is less volume this period than before, that simply means that there's less outside paper. All trends are made by outside paper. And no matter what kind of technique you use to try to find where these trends start, whether it's the oscillators that Linda was talking about or the stuff that Russell was talking about, it doesn't matter. But it always comes with an increase of volume. So anytime you see an increase in volume, that should be some kind of a red flag. The thing that you also have to have, though, is you have to have some way of measuring the effect of that volume. What happened when that volume hit the floor? Did that make the market go up, or did it go down, or did it stay the same? Remember back in the spring when Greenspan had the 0.75% hikes in interest rates? Remember one time the bonds did nothing, one time the bonds went way up, and one time they went way down? Same news, same comments on CNBC, this sort of thing, but the market acted totally different. So one of the reasons, and as they were pointing out today, when you have a market that's in a bracket, this is where you make the money. Money making in a trend is very easy. Giving it back is difficult there. In fact, one of the things you oftentimes hear traders say is making money in the market is easy. Keeping it is very difficult. And you heard Russell talk this morning about how much he made and how much he gave back and this sort of thing. You give it back in here. What we wanted to do was we wanted to figure out some kind of a technique that would let us know when the market was in a trend versus when it wasn't in a trend. And back in those days, this was like 1980, 1981, trading in a bracket to me looked like trading in mud. I mean, I like to run, I enjoy running, and it looked like the market was just in the mud. Then when it got into a trend, it looked like you had hit the concrete. Now you can go faster. So the first thing we called this was a mud factor. And then after we got a little more experience with it, we started calling it a different thing. We started calling it tick mileage, because what it told us was how much price mileage you get out of every tick. And it's a very simple formula. The market facility, and then in 1987 we got very, very sophisticated, and we decided to give it a long name because that sounds more professional, and called it the Market Facilitation Index. The MFI is nothing in the world except the range divided by the volume. And if you do the range by the volume, and you can do this on most techniques, you can certainly do it on Telerate. Is Bill Cruz here? No, Bill's coming in a bit later with Omega. You can color the bars on Omega or on TradeStation. You can color the bars and make them a different color. Now, what you're getting here, obviously, is what? You're getting a difference in price per tick. Now, this does not mean anything. The number does not mean anything, and we're on page 12 now. The number only means something in comparison to the most recent numbers. So if we have an MFI, let's say a 0.546, that has no connection at all with 0.546 from yesterday. But it does have a great deal of connection to the immediate preceding bar, whether you're talking about 1 minute or 1 month bars. They're all the same. And everything we're going to talk about applies at all time frames. Principle in the science of chaos and in fractal analysis is called the self-similarity principle, which basically, in our terms, means if it doesn't work on all term charts, it's not a fractal. So if the last bar only had a 0.451, then that means that this bar, the 546, is moving price through time at a faster rate than the previous bar. Right? Is that understandable? So we want to jump on these. Now, if we have the volume and we have the MFI over here, the two things we want to talk about is what we call a green, which is where you have an increase in volume and you also have an increase in MFI. So what that means is, let's say the market's going up and the price attraction attracts more buyers in, and there's a bias toward the buy side. Not a bullishness, but a bias. There are more buyers than sellers, and that's why the market goes up, and that's the only reason the market goes up. Then we're on a runaway wagon. We're on a train that's going out of town. This is the time you don't want to buy low and sell high. But if we have a different one, which we call a squat, because the market is squatting down and about to go the other way, is where you have increased volume, but there's a bias toward the sell side. And all trends, and in the notes I backed up and I said 99.5% of all trends, but between you and I'll tell you, all trends end in a squat in one of the three top bars or one of the three bottom bars. So you can locate a change in trend plus or minus 1 bar in any size time frame you want to look at. And if you get TradeStation and put the squats in red, at every change of trend you'll see a red in there. Now, all trends end in a squat, but all squats aren't the end of the trend. The other places that you get a squat are at the middle of a third Elliott wave, we'll be talking about that in the next hour, or at a Fibonacci retracement. All of these points are very important, and you can pick them out on one of these colored charts very, very easily. So the MFI gives us a way of looking at how the market is digesting itself. Okay, let's go from that. So at the level 1, then one of our primary tools is using this MFI and the Profittunity windows. The Profittunity windows that we look at mostly are the greens and the squats. And then we move up, and the purpose of the novice level, the goal of the novice level is to not lose money while gaining experience in the market. Now, one of the interesting things about this breakdown is that you can always, every day, every year, every month, every lifetime, you can always know exactly where you are on what we call the ladder to trading success. You also will know exactly what you have to do to go up to another step. So the next step up is what we call the advanced beginner. Now, at the novice level, you're taking a microscopic view of the market. You're only looking at 2 bars, no matter what the time frame. You're looking at the present bar and the immediate preceding bar. That's all you're looking at. At the second level, you start taking a panoramic view. At this level, you're looking at any number of bars. And so you're looking at a lot of different bars. So look over on page 15 in your chart, and you will see this is an S&P 5-minute bar, but the squats are marked with S, the greens are marked with G, and the S's, and you can see the greens and the squats, the squats, the squats, and the greens and the squats, and the greens and the greens down here. And you notice there's a squat there, but there's not any squats down here, and the market continued on down. The next step we want to do is to look at the Elliott wave and look at the fractals, and that's at the advanced beginner level. That's at this level here. And the goal here is to make money on a consistent basis on trading one contract. Since I make my living trading, I look at trading as a business. And if you're in the business, let's say you're manufacturing these laser wands, what you want to do first of all is you want to make sure you have a good quality product. Because if you go out and say, hey man, we need to make a lot of money, we need to sell 1 million of these things, let's put on an advertising campaign and you sell them. But the quality is not good, you're going to have a lot of returns, aren't you? You're going to have a lot of losses in there. So before you start turning up the production, which in our case is trading multiple contracts, you need to make sure that you can make money consistently on a one-contract basis. Now, if you're not making money consistently on a one-contract basis, you're not at the advanced level. You're not an advanced beginner. You're somewhere lower than that. The way to make money consistently on a one-contract basis is to use everything at the novice level and add to that the Elliott waves and the fractal. And when you can accurately and adequately use the fractals and the Elliott wave, I will guarantee you that you can make money consistently on a one-contract basis. So let's look at a fractal, and let's look at what a fractal is. Basically, a fractal is a change in behavior. When you decided to attend, and see, one of the things that amazes me really is that most of us look at trading as hard work. It isn't. It isn't hard work at all. It's very easy and should be very low stress. Trading, you've done trading all your life. You've been a winner all your life. Let me give you an example that's real that you may think is a little off base, may not be. Your mother, during her childbearing years, had roughly about 750 ovums. These are eggs that might be fertilized. So right off the bat, you were a lotto winner. You had 1 out of 750 chances of being here right now. Now, if you'd been any one of those other 749, you wouldn't be here. Now, add to that the other side of that equation, which is your father. Now, your father, that particular time your father and mother made love, he ejaculated, and he had roughly about 1 million sperms, and you were one of that 1 million. And there were 999,999 other sperms who were swimming for their life just like you were. You didn't just happen to get here, you see. I mean, this is a hard, difficult process. And you made it. I mean, 80% of you died in the vaginal canal. And only 200,000 made it past that. And you were 1 in 200,000 that this 1 in 750 eggs decided to let in the first place. Now, what if your mother and daddy had gone to the movies that night instead? You know, what if they'd gone to see the Flintstones or some other thing? You wouldn't be here. Now, go even further. What are the chances of your mother and father meeting in the first? Let me give you a personal example. My grandfather was a conductor on the old L&N, NC and St. L Railroad out of Elora, Tennessee to Nashville, Tennessee. And my father was living down in Greenville, Alabama. Now, one winter back in 1921, I guess it was, my mother got sick, and she had the flu. And in Elora, there was no good doctors, so my grandfather, who was a railroad conductor, was going to take her to the doctor in Nashville the next day. They were down at the railroad station waiting to get on the train when the train company called him and says, "No, we're bumping you till tomorrow. You go back home. You're on this schedule tomorrow." So they went back home, waited another day. My mother still had the flu, and on the next day they got on the train. Now, my father happened to get on that train. If my mother hadn't had the flu, if the NC St. L Railroad hadn't bumped my grandfather one day, I wouldn't be here, and you wouldn't be here either. Not right now, not in this. So winning in the market for you, and then you go back to all the generations and all the chances there. Winning is nothing. I mean, you were the big winner in the universe. So winning should be simple for you. It's not something that's that difficult. So these fractals are very, very simple. All a fractal is a change in behavior. That's all it is. Now, there are several ways to mark this change in behavior, but remember that it's a change in behavior. When you decided to come in here, you traded the opportunity to be in at least 3 other places, didn't you? That was a trade you made. You trade all your life. You trade many, 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 many times. Now, I'll have to confess something that's real unique to me because I know no one in this whole room has ever done that. I have had times in my trading where I've decided to take a trade, pick up the phone, dial the broker, and just before he answers, I'll hang up. Now, I know that's never happened to you, but I've done it. That's a double fractal. That's a bracketed market. You see, it goes like this. And we do that, and that's a fractal. So when you decided to come in here, you risk losing what you're not hearing. And what is the first words that we raise our kids with? What's the first words most young kids hear? No, right. Which means what? Don't take a risk, right? Don't touch the hot stove. Don't kick the dog. Whatever it is, don't do it. Don't take risks. And yet all your life up to that point, you were risking. 1 in a million, 1 in 750, all this kind of stuff. You've risked all your life. This is natural. Trading is a very easy, low-stress, natural thing to do. You only make it difficult by looking at the wrong paradigms. It's like if I had a broken arm and you looked at it, you might say, "Well, Bill, it's messed up, but man, I don't want to touch it." But if you were an orthopod and you looked at an X-ray, you might say, "Well, we've got to do this and put a pin here." You'd see the underlying structure of it. So what we want to do is see the underlying structure. Now, to demonstrate that, you have 2 green sheets there. And those of you who came in late may not have 2 green sheets. I don't know if there are any more back there or not. There's no more, Rick. Okay, take one of these green sheets and put the other one aside for just a moment, and let me pull one up here. Okay, this is what it should be looking like. Now, this is a sheet of random numbers. You'll need 2. You're supposed to have 2. This is a sheet of random numbers, and this is a little game. This is a pop quiz. And I'm going to time you in just a moment, and don't do it yet, but 1 is up in the upper left-hand corner. If 1 is not in the upper left-hand corner, you have the wrong page. But 1 is up here in the left-hand corner, 2 is right there. So what I want you to do is, in a minute, when I tell you to go, put your pencil on 1, draw a straight line to 2, draw a straight line to 3 without picking up your pencil, and every number you get will be a winning trade. We're going to see who's the best traders in here. Any questions? And I'll time it. Okay, get ready, go. Start with 1, go to 2, then 3, then 4. Okay, stop. All right, how many of you got 5 or more? May I see your hand? Oh, okay, good. How many got 10 or more? Oh, that's weeded a bunch. How many got 15 or more? How many 12 or more? How many got 12 or more? How many got 11? Okay, 2, 3 people got 11. Okay, let's see if we can do something. Throw that sheet away or put it away. Take the other clean sheet out. Now, we're going to do this thing over, and I realize that you've had a practice effect, but nobody's had a practice effect above 11. Would you take your sheet and fold it long ways, this way, and then crease it, and then open it up, and then just meditate on these numbers a little bit and see if you find any underlying structure to these numbers. Anybody notice anything unusual about the numbers on one side versus the numbers on the other side? Right. All the odds are on the left side, all the evens are on the right side. So that means that every trade you make, you've got to cross the line, don't you? And that line, of course, is risk and fear and all this sort of thing, but you've got to go from left to right to left to right. So that eliminates half of your indicators right off the bat. Now, take your paper and also fold it this way, and then open it up. And this underlying structure is a little bit more obscure, but it's still there. And I'll tell you what it is. If you notice, the first 6 numbers are on the top half, 7 through 12 are on the bottom half, 13 through 18 is on the top half, 19 through 24 is on the bottom, 25 through 31 is on the top, this sort of thing. Every 6 numbers, or 30, every 6 numbers you have to go from top to bottom. Now, since you've had a practice effect, what I'm going to do is I'm going to cut your time down 1/3. You're only going to have 60%, 66% as much time as you had on the first one. That's to eliminate the practice effect. So with only this much knowledge of the underlying structure, let's try this again on the new one. Okay, get ready, go. Four, 3, 2, 1, stop. Okay, let me go way out on the limb. How many of you got 11 this time? Ooh, look at that. Okay, how many got 15? Okay, now you're going with only 2/3 the time. Let me ask you this. How many of you got twice as many as you did the first time? Look around. Okay, you got, that looks like 90% got twice as many in 2/3 the time limit. How did you do that? What made you more successful? You had a little bit of knowledge of the underlying structure. And that's what the fractal is all about. Now, a fractal in the market is very, very simple. When the market goes up, turns around and starts the other way, the market has made a decision at that top middle finger. And that decision is that is a fractal. Now, a fractal is very easy to define, and it's defined well in your notes, I think. A fractal is a sequence of 5 bars where the high bar is preceded by 2 lower bars and followed by 2 lower bars. That's all it is. Very, very simple. One of the things we do in our tutorial is that we throw a lot of charts at you, and we give you 60 seconds to analyze any chart, knowing exactly what you should do on each bar, where you should pyramid, get out, stop in reverse, or whatever. Our goal for you after 30 days of being in the 30 days after the tutorial is that you can analyze any chart in 10 seconds or less. I have spent decades of my life spending 5, 9, 11, 12 hours a day analyzing the market, and usually devoting one day over the weekend just to generally analyze the week. That did not prove to be a profitable endeavor. I would probably have made about as much money slapping hamburgers together as doing that. One of the problems of spending too much time with this paralysis of analysis is that you overlook the other opportunities. And the people you've already heard today have talked about the real opportunities come in only about 15% of the time. But if you
Please stop.